If you've ever lost money trading options, it's probably because you don't understand implied volatility. Welcome to Stock Charts Trading Weekly Indicator Alert Review of Implied Volatility Indicator. Implied Volatility Indicator ranks how much option premium you're paying, so it's very important to know how it works. What is implied volatility? Implied volatility is the edge option makers use to collect in a premium from you and then deflate down that premium, putting the odds in their favor. How does implied volatility work? Implied volatility is directly influenced by the supply and demand of the underlying options and by the market's expectation of a stock's price direction. And this is 100% true. Implied volatility is a directional indicator. But if you're not careful, you'll get contradicting information like this says, what does implied volatility tell you? Implied volatility shows the stock's potential moves, but it does not forecast the direction. So why are these two things saying totally opposite things? Because it's talking about different scenarios. One is the typical direction base of implied volatility. There's a saying for that. When implied volatility is high, it is time to buy. When implied volatility is low, watch out below. The market's about to sell off. To prove the point, let's look at Dow Jones Industrial. As you can see, every time the implied volatility is high, it was a great place to buy the Dow Jones. So if you like to buy the dip, this would be the perfect indicator for you when using indices. The second scenario said that implied volatility did not tell you what direction, it was referring to earnings. This is a great place for market makers to take away premium profits from you. In this scenario, you'll see all of the arrows just before these blue-red, which indicates company reporting. In a lot of these scenarios, the stocks went up, besides the 2 times in red, which the Dow Jones always rallied when the implied volatility was high. And here's what you have to recognize about implied volatility for option makers when it comes to earnings. They raise the implied volatility higher, not determining the direction the trade will go, but just charging you more for the ability to buy the option just before earnings. And why do they do this? Because they deflate the implied volatility, making it very hard for you to make money. Even though you got the direction right, you might have lost or broke even because the implied volatility went lower, taking away from your option value. This is a trick that market makers are able to do to protect themselves from paying out big rewards to you for getting the direction right. If you want to become a master at options trading, it's not so much about the direction of the trade, but more about implied volatility. 2 reasons for high implied volatility. If you know around earnings that implied volatility will naturally raise up so that the option makers can sell it off, when you see scenarios like this, thinking it's a great buy the dip wedge formation with implied volatility going up is a big mistake, because when it comes to earnings release and high volatility, it is not a directional base for you to take a trade. In this scenario of DocuSign, every time it had high implied volatility right before earnings, the stock and implied volatility both sold off. Please understand this information when using implied volatility. When it's high, it's time to buy, but not with an earnings release. Now, the way I like to trade implied volatility is by using my stock trend indicator and implied volatility midpoint indicator. If you don't have a stock trend indicator, you can use something else like a moving average, Bollinger Bands, something that will give you a directional view of where the trade is going. And if you don't have the implied volatility indicator, that's fine too. You can just click on your line tool and draw the midpoint on each one of your implied volatilities to identify if implied volatility is high or if it's low. Remember, high implied volatility means time to buy. So when you have a stock uptrending, bouncing off some kind of support, and not too close to an earnings date, this will give you a phenomenal entry points, going up with the trend. See how easy it is to make money? But remember, you would have got the direction of the trade right, but you wouldn't have made much money because implied volatility sold off. And we're going to discuss that about option strategies. Whereas if you were in a bearish setup, when implied volatility is low, watch out below. Look how prices sold off, and every time it did that, the implied volatility indicator went up, showing that your option value was added to, giving you more premium. That's what I like to call a double whammy. When you see things like this, you start to change your strategy so that you'll be able to profit more and consistently and bigger than having the option value deflated away when you get the direction right. Put options are almost always a sure win because the implied volatility is so low. That's why I highlight the top half of the stock trend indicator red and the bottom half of the implied volatility indicator red to match, giving me great consistent trading signals to take profits. No matter the chart, look at this, right after earnings, it starts to sell off as typical. If you would have seen this up against resistance after earnings, you would have noticed the implied volatility was really low, being able to enter into this position back down to support as the implied volatility were to race up, giving you lots of profits. Again, after earnings, we see implied volatility go down. We see this trade setup happening over and over versus the losing trade setup of buy the dip, where the stock value goes up, but the implied volatility goes down. So if you can find stocks like Marvel up against resistance with the implied volatility going down below the lower half of your implied volatility indicator, this should be signaling to you that implied volatility will start to raise up as this stock sells off back down to the support level and even lower. Look what happened last time. Price came up into this horizontal area while implied volatility was low. Implied volatility raced up as the stock price sold off. That's why you can be pretty confident of trading this setup over and over again. PPG had a big gap up today into resistance, not only the trend indicator resistance, but also this horizontal line, looking as a great place to short it. And we're after the earnings are released, which is great because the implied volatility is selling off, giving us better option value for our puts. Last time we could see this made the topping pattern. Implied volatility was low, squeezing together, broke out, and implied volatility had a big run up as the stock sold off lower. Where the implied volatility indicator is does not reflect the size of the move, because you can see here it was a little bit higher and the move was even greater in size. Then implied volatility was even higher and the move lower wasn't as big. Based on results, these two small moves were at different IV ranking levels, and these two were also at different levels. So based on that, the current IV level does not tell me how far this is going to go down. But there are some other factors of implied volatility with momentum. The momentum of implied volatility. The momentum of a stock is very important to consider when trading. It is different from the trend. A trend will be longer in nature, but have different momentum, both bullish and bearish, within that long trend. For more on this, go to Stock Charts Trading YouTube playlist and click on Trading Analysis, How to Read Stock Charts. In there, you'll learn about the Elliott wave pattern. In this scenario, we can see that it's a clear downtrend, and the momentum moves are much bigger with the trend than the counter trend momentum against the trend. I always like to say downtrend, down trades, and when using these two indicators, the downtrend is easy to locate. Down trades mean always look for something up against resistance with the confirmation of low implied volatility. This one was just after earnings, and so implied volatility was extremely low. As it sold off, as normal, implied volatility raised up, and in this instance, we were just before earnings. And remember what happens at earnings. Typically speaking, implied volatility raises up, which it did. And getting the trend direction correct too, you would have been able to make huge profits. Now for uptrend up trades. When a stock is uptrending, you'll look at your support levels and make sure that you have high implied volatility. Without any interference of an earnings date, this is the perfect place to buy. Now the reason why I want to talk about momentum is stock trend momentum is going up. And the momentum of the price action is pulling back down to the support, making highs and lower highs with lows and lower lows. And this is how close implied volatility is tied to price action. See how you have the lows and then implied volatility has highs, making a divergence. Stock momentum can also be identified in implied volatility momentum. Every time the stock moves, the momentum should have a counter reaction to that stock move. And when it doesn't, that's an anomaly within price action and the option premiums of the implied volatility. As you can see, it's red right here, and we're in the red zone. Price action went higher as the implied volatility went higher. But once it made the correction, it's back to normal. High implied volatility, time to buy, and it sells off as the price action goes higher. Both implied volatility and stock price are in the red zones, giving price action and implied volatility a different momentum. Understanding the momentum of the implied volatility when the trend is going up or down is very important for you to familiarize yourself so you can start to identify the normal behavior of price action with implied volatility. The more consistent you get with understanding this process of the divergence between price action and implied volatility will help you have better entry points. Let me show you why. As you can see right now, we have resistance on the stock trend indicator. We also have a gap fill up into resistance. And I'm sure we're at 61 retracement on a Fibonacci. from these highs and lows. You could probably even argue if you were using a bear flag indicator, you'd see that there's a signal right now also, which means if you're watching the video, this could be a great time to enter into a trade. But remember what we said, we're talking about entry points for momentum. And the best way to create entry points on implied volatility is to make channels. So let's zoom in so we can make a better channel based off this implied volatility and price action. We can see implied volatility going lower and the retracement upward of this bear flag pattern, creating a divergence. Implied volatility going lower in the red zone as price actions going higher, also in the red zone. When using channels, you want to identify where the last turning point was so you can start your channel accordingly. In this case, we can see that implied volatility rose up as the price action came back down to the support level. Then price action rose up as implied volatility went lower. So in order for price action to go lower now to continue with the trend, implied volatility would have to break out of this channel. So what do we know about channels? Channels are made up of two lines. One is a support line and the other is a resistance line. The way I like to use implied volatility for entries on a bearish trade, I would look for the IV to be at support, as you would look for price action to be up against resistance, which is just the opposite of price action, which you would look for to be up against resistance. The second way I would use implied volatility as an entry point is if it broke outside this channel, then came back down and bounced, retested off of that resistance line, I would want to enter into the trade there. But with so many factors of confluence, I think today is a great day to enter into a trade. I would consider, if price action did go a little bit higher, to take another trade. Because remember, we are in a downtrend. Let's look at another downtrend. Identifying this area of support would make us draw our eye into the implied volatility here. In this case, implied volatility was going up as the price action was going lower. So remember what we said before. In this case, we saw implied volatility break out and go lower and then retest your channel, giving you the perfect place to enter into a trade. But now that implied volatility is going lower, as price actions coming up into resistance and implied volatility is relatively low with this earnings report coming out, we might not want to take this trade. But maybe you want to keep a close eye out on Apple. As this implied volatility goes up into earnings, we know there's a high likelihood of that implied volatility selling back off. And if it lands on this support side of the channel, that would be a great place to take a trade as long as price action is close or possibly higher. Now here's a couple tricks I personally developed over the years. Out of all these points of high implied volatility, nothing really matters to me. But this one, because I'm at support. This is the first indicator for me is where's price action before I look at implied volatility. Next, that I see that price action is at support, I know that price action is going down and implied volatility would do the opposite. So I'd want to make a channel on implied volatility and I would just look at all of the highs implied volatility has made in the past. So I would just look at the highs implied volatility has made and the lows to create the channel. And you would see this high point up against resistance is the perfect support place of price action. So looking at this uptrending chart, the first places I'm going to identify are support areas. Now that I see this bull flag pattern with the MACD divergence coming down lower into the support area of the stock trend indicator and the implied volatility is high, I just take the tops of the implied volatilities to draw a channel line. And sure enough, right at that resistance point is the support point to enter into this trade long. In this case, it might start to make you really happy because you have low implied volatility when you're at a support level, which means the possibility of price action going up and also implied volatility. But it didn't really go down either. It basically just stayed flat, not helping nor hurting. And this is where it's important for you to become a master of your trading portfolio. You could see that price actions at support with a nice divergence of the trend indicator, but you have an earnings. And of course, the implied volatility is high. So this is probably not the best place to buy. But if you were to look at the next support area of the trend indicator and see that implied volatility was relatively low, this would have been a better place to buy a call option as price went higher. Even though option makers did their old tricks of deflating implied volatility, you might not have lost as much of your premium as it sold off lower. But I've got a trick for that. Hold on. So in this scenario, we're looking at a bearish setup and we can see that price action is up against resistance. Now, how does the implied volatility work? It goes down as price action goes higher. So when implied volatility breaks out of that downward channel, then retests that support channel right as you come back into that support area, this is a perfect place to take a down trade on an implied volatility retest. Price action sells off lower as implied volatility goes higher, making you nice profits. Now, how to use implied volatility for making money with options. When you buy the implied volatility indicator, it's set up to match the saying, when implied volatility is high, time to buy. When implied volatility is low, watch out below. But if you can only buy options, either calls or puts, here's a way you can change the implied volatility indicator to put it into your advantage if you're not able to do an advanced trading strategy. Click on your studies beaker, then click on your implied volatility. I've named mine midpoint. When you double right click, you can click on edit source. And if you rewrite these two colors, where pink is, write light green, and where light green is, write pink, to look like this, then change the name to save it and click OK. If you want to change the color of the line of your implied volatility, click on here. You get a lot of options, or if you want more colors, just click on here. I like black, number 2, click OK, and make sure that the indicators come in the lower portion of the study, not in the area of price or volume. If it does come up there, you could just drag and move it lower to the lower study. In this case, we're going to look at the difference between the original implied volatility, when it's high, it's time to buy, versus the new implied volatility for options. When it's high, it's time to sell an option versus buy, even though your price action is saying it's time to sell a put instead of buy a call. This is an advanced option strategy. As price action goes higher, you sell the put and it will lose value. I just want to show you the difference. First, you have to determine what the trade setup will be. In this case, we could see that the trend is going down and we're up against resistance. So at that point, when considering an option, we would look to see if we should buy or sell. And in typical fashion, you would always buy puts because implied volatility is low. Because implied volatility is typically low with buying puts, we're going to review some calls. Taking the first indicator away, the trick to buying calls with low implied volatility is look at your earnings dates. And after the earnings date, start looking for low points of implied volatility. Here we see low implied volatility. Price action went higher, and so did implied volatility. If you would have bought call options here, you would have made money. Here we see low implied volatility. As price action rallied up, so did the implied volatility, making you money. Even back here, we have low implied volatility in the green zone. Price action shot up, but implied volatility creeped a little bit lower, which is not typical because of earnings. So the trick is looking at the earnings dates. After earnings, look for low implied volatility. And when you see a low implied volatility, buy your options with the likelihood that implied volatility will go up with your call options. Having a moving average or some kind of system that determines if a stock is bullish or bearish is a very big help, because you can't just use low implied volatility being green as a buy place for options. These trades would have resulted in losses and you'd be very upset with me. Trend is important. In these two scenarios, after earnings, low implied volatility, price and implied volatility both rose up into the next earnings date. After earnings, low implied volatility, price action rose along with implied volatility, giving you lots of profits into the next earnings release. This happens over and over. You just have to be mindful and look for it. But remember, you need some kind of trend indicator to show you not to take these trades. After earnings, low implied volatility, price action and implied volatility rose up, but did fade away. That might be something to consider when thinking about targets. Would you use this midpoint as a good place to take profit? You can see the implied volatility doesn't typically stay at these highs and low points like it did here. Next earnings, right here, and implied volatility is relatively low. Or maybe you get in a little bit later, low implied volatility. In either case, the value of the stock option went up along with implied volatility. This is how you make money in the market. Can you see it now? Implied volatility is a big factor. All right, let's put it all together. Price action's coming lower. We see a breakout right here with a nice little retest. We're after earnings with very low implied volatility. Ding, 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 ding. Implied volatility goes up as price action goes up. Great way to make money. Can you see it? Downtrending. After earnings, low implied volatility. Price action goes higher along with implied volatility. That's a winner. Do you see another one? Earnings, downtrend channel, breakout, retest, along with low implied volatility. Price action raises, and so does implied volatility, making you some money. Stop the video and look for yourself to see how you would make this trade. Look at the earnings first, then look at all the bull flags. Draw a line across the top of the bull flag, look at the implied volatility, see if it's low, and if it is, it's time to buy. In each one of these cases, besides this one, because it had high implied volatility, price action went up and implied volatility went up. Locate your earnings, identify low volatility areas for you to buy call options. Price action goes up, implied volatility goes up. Here you would have had to been careful because implied volatility spiked down just before the earnings. It's not typical, but it does happen. Locate your earnings. Look for low points of implied volatility after the earnings. Each time price action went up and so did implied volatility. Downtrending stock, right after earnings, low implied volatility, price action went up, and implied volatility went up. And again, big sell-off after the earnings release, low implied volatility, price action rallies up, implied volatility does also, but then pushes lower right when price action's at the high and rockets right back up for earnings. GameStop, after earnings, downward channel into this wedge formation, low implied volatility, perfect place to buy some calls. Price action goes up, and so does implied volatility, making you some money on GameStop. HAL, after earnings, we got one right there, looking for a downward channel breakout, then retest, right when implied volatility is low. Price action makes a big run up, along with implied volatility. Same thing back here, low implied volatility, raises up a little bit as price action goes higher. Right before earnings, get out of the trade. Have you ever heard the scenario, sell the news? Buy the rumor, sell the news. Buy implied volatility when it's low, get out before earnings. Go ahead and skim your profits off the table, collecting in that option premium. I hope that really registers with you when to buy a call option. After earnings, look for low implied volatility and some kind of support resistance indicator on the price action. At that point, you got a pretty good chance of making money. When to get out of the trade could be based on implied volatility when it hits a high or some kind of Fibonacci extension or resistance on Bollinger Band or technical analysis that you do. Trading analysis setups. Now let's put it all together, what we've learned about implied volatility and price action, because there's nothing better than actually doing it for real-time education. Using the stock trend indicator, we can see that Apple is up against resistance, making a nice bear flag wedge formation. It is before earnings, but as price action went up, implied volatility went down, which is typical. So we know we're not in an anomaly right now. Looking at the overall chart, we can see that Apple has a heavy support and resistance line right now. Old resistance became new support and is now old resistance. Maybe on a bigger time frame, this would look more like a head and shoulders pattern, which means the potential for this trade could be huge after it breaks the neckline. Duplicate this range box down. Another thing that could have happened is here's the neckline based off this double or triple top. Duplicating this range box would still give us a lower target. Either way, I think Apple has a lot of room to sell off. Take it from the highs to lows, it's a 30% move, almost 90 days. And that would look something like this, putting us to late October for an expiration date. I think with the anticipation of such a big move, this quicker support level of around $130 is the better target. Of course, you'd still use the October expiration, giving you plenty of time for this trade to work out because price action might bounce off of the support level before breaking through. Since we've identified that we're up against resistance and this is going to go down and the option value is relatively low, that means you should buy some puts. Looking at implied volatility, we are coming into a support level even though the implied volatility has been raising over the last year. And this is typical that implied volatility will raise as the stock sells off. Remember, everything's a divergence with implied volatility in the stock price. So where could you take targets? You could use the top of these implied volatilities, and depending if the price action hits the support level as the implied volatility comes up into this resistance, might be a good place to take some profits. The next place, which would be a little bit higher, is if you used a horizontal line off of this old implied volatility high. Of course, the hope is that as implied volatility goes up, price action will come back down to this support level, making it an extremely profitable trade for you. Next trade setup that we're looking at, CBOE. We see price action making this little plateau here. Price action made this bear flag as the implied volatility went lower. Very typical. We also have a MACD indicator right against the stock trend indicator. Great indication that this is going to sell back off down to a support level. We can take from our highs of the implied volatility and bring it down. Zooming in, and you see implied volatility bounced off of that support level right here at that candlestick high. And since then, implied volatility has started to raise up as price action rose up. What happens as implied volatility raises up? Price action comes down. So this little move right here on the implied volatility is telling you there's a change in the momentum of this stock price. If we measure from the lows back to the old highs, that's 200 days, which is a huge move, way too long for us to buy some options on. So let's look at the old highs down to these lows. That's about 40 days on a 15% move, which would be a little bit closer to late September. I would just go ahead and go out a month to October lower since option premiums are so cheap here. That will afford you a lot of time for price action to move back and forth, even if it makes a lower high before coming down to the support level. Of course, this is a great trade setup because implied volatility will break out of this downward channel and start increasing. Now, here's another little trick. Go wide when you're making your new channel. Have you ever heard old support makes new resistance? Of course, you can change this channel as the implied volatility moves around within it, but you start to see a lot of confluence in the implied volatility, like these 4 points here, exactly at the same place, would indicate there could be some resistance, which also confirms your channel. If this happens and you're at the midpoint of $110 and haven't quite reached the $105 target, maybe you take off some of your profits. Remember, this could happen because you have an earnings release coming up too. Here we see Costco, it's holding its value over a lot of other stocks. It's still relatively high, maybe making this head and shoulders pattern here, but the trend indicator is definitely showing that it's a downward bearish setup. It's been making pretty clear channels on the implied volatility where to get in, and it seems like it's making a heavy support line here, bouncing off 6 times as the price action goes higher. Now that Costco's up against resistance, it could go a little bit higher than this 530 mark. You measure from your highs to your lows of this last big move, around 60 days, 30%. That puts you at late September, down around $400 for a target. Again, I think the better option might be this October expiration date, because maybe Costco might go a little bit higher into the trend indicator. And at that point, you'd have to recalibrate the days of the trade. Zooming in, there's a couple ways you could do this. Because you're up against this bear flag pullback, you could enter into the trade now. You could use the support level of the implied volatility. You could wait for a breakout retest or a breakout retest on implied volatility. You got to consider how this works with your strategy, what's best for you. Why is implied volatility important? Implied volatility uses all of the Greeks, combines it together, makes a calculation for the market makers so that they can cheat your option trades. Implied volatility is the most important trading indicator that you're going to be using if you're using options. Market makers' favorite thing is to overcharge you and then steal that overcharge premium away from you, deflating the value, having you scratch your head. What happened? If you're a thinkorswim user, I highly recommend you using this indicator to help you. It will advance you quickly to be able to analyze, should you buy, should you sell, are you at support, are you at resistance, are you breaking out, creating higher probabilities for you to be able to make more profit. If you're interested in the indicator, go to stockchartstrading.com and click on implied volatility. Of course, like this video, we have indicator alerts, and every week we use different indicators showing you how the market's setting up so that you'll be able to successfully trade it. In actuality, you never have to buy an indicator from us. You can purchase indicator alerts and every week have a real-time assessment of what the market's going to do and trade it on your trading platform. So you can create the mind of a trading program that you can do for yourself.